Section 31 to 3.3 Emerging Markets, 3.1 Currency and Exchange Rate Risk. Currency fluctuations can have a significant impact on investment returns in emerging markets. Here are some key points to consider regarding the impact of currency fluctuations on investment returns. Exchange rate exposure. Investments in emerging markets involve exposure to foreign currencies. Fluctuations in exchange rates between the investor's home currency and the local currency of the emerging market can directly affect investment returns. If the local currency depreciates against the investor's home currency, it can reduce the value of investment returns when converted back into the home currency. Currency risk. Currency risk refers to the potential for losses due to adverse exchange rate movements. Emerging market currencies can be more volatile compared to major reserve currencies such as the US dollar, euro, or yen. Higher volatility increases the uncertainty and risk associated with currency movements, making investment returns more unpredictable. Hedging strategies. Investors may employ hedging strategies to mitigate currency risk. Hedging involves using financial instruments, such as currency futures, options, or forward contracts, to protect against potential losses from adverse currency movements. Hedging can provide a degree of certainty and protect investment returns from the impact of currency fluctuations. Diversification benefits. Currency fluctuations in emerging markets can provide diversification benefits to a portfolio. Currencies do not always move in the same direction as other asset classes, such as stocks or bonds. By investing in different currencies, investors can reduce the correlation between their investments and potentially benefit from currency movements that offset losses or enhance returns in other asset classes. Transaction costs and liquidity. Currency fluctuations can also impact transaction costs and liquidity. When converting funds to the local currency for investment or repatriating returns back to the home currency, the prevailing exchange rate determines the cost or value of the transaction. Investors should consider the impact of currency fluctuations on transaction costs and the availability of liquidity in both the investment and repatriation phases. Economic factors and currency movements. Currency fluctuations are influenced by various economic factors, including interest rates, inflation rates, economic growth, political stability, and external factors such as global trade dynamics. Investors should assess the economic fundamentals of the emerging market and monitor key economic indicators to understand the potential drivers of currency movements and their impact on investment returns. Long-term investment horizon. Currency fluctuations in emerging markets can be volatile in the short term, but over the long term, they may revert to their fundamental values. Investors with a long-term investment horizon may be able to ride out short-term currency fluctuations and benefit from potential currency appreciation or stabilization. It's important for investors to carefully evaluate the currency risk associated with investing in emerging markets and consider their risk tolerance, investment objectives, and time horizon. Currency risk can impact investment returns positively or negatively, depending on the direction and magnitude of exchange rate movements. Diversification, hedging strategies, and monitoring economic factors can help manage currency risk and potentially enhance investment returns in emerging markets. Hedging strategies and risk management techniques are essential tools for investors and businesses to mitigate various types of risks. Here are some common hedging strategies and risk management techniques. Currency hedging. Currency hedging involves using financial instruments such as futures contracts, options, or forward contracts to protect against currency fluctuations. For investors in emerging markets, currency hedging can help mitigate the risk of adverse exchange rate movements. By entering into hedging contracts, investors can lock in a specific exchange rate for future transactions, reducing the uncertainty associated with currency risk. Portfolio diversification. Diversification is a risk management technique that involves spreading investments across different assets, sectors, regions, or currencies. By diversifying their portfolios, investors can reduce their exposure to any single investment or market and potentially mitigate the impact of adverse events. Diversification helps to minimize the overall risk and can provide more stable investment returns. Derivative instruments. Derivatives are financial contracts whose value is derived from an underlying asset or benchmark. Options, futures, and swaps are commonly used derivative instruments for hedging purposes. They can be used to hedge against various risks, including interest rate risk, commodity price risk, or foreign exchange risk. Derivatives allow investors to manage and transfer risks efficiently. Risk assessment and measurement. Effective risk management begins with a thorough assessment and measurement of risks. This involves identifying and analyzing potential risks, estimating their potential impact, and understanding their probability of occurrence. Techniques such as risk assessments, stress testing, scenario analysis, and value at risk (VAR) models are commonly used to quantify and measure risks. Insurance and risk transfer. Insurance is a risk management tool that transfers the potential financial losses associated with specific risks to an insurance company. Businesses can purchase various insurance policies, such as property insurance, liability insurance, or business interruption insurance, to protect against unforeseen events. Insurance helps mitigate the financial impact of risks and provides a level of security. Contingency planning and business continuity. Contingency planning involves developing strategies and action plans to manage and mitigate potential risks and disruptions. It includes identifying critical business functions, establishing backup systems and procedures, and ensuring business continuity in the event of adverse events such as natural disasters, market disruptions, or geopolitical risks. Contingency planning helps businesses respond effectively to unexpected events and minimize their impact. Risk monitoring and review. Continuous monitoring and review of risks are essential for effective risk management. Regularly assessing the effectiveness of risk management strategies, reviewing risk profiles, and updating risk mitigation measures based on changing market conditions and emerging risks are critical. Risk monitoring and review allow investors and businesses to adapt and make informed decisions in response to evolving risk landscapes. It is important for investors and businesses to understand their risk tolerance, objectives, and the specific risks they are exposed to. Hedging strategies and risk management techniques should be customized to align with individual circumstances and investment goals. Consulting with financial professionals and risk management experts can provide valuable insights and guidance in implementing effective hedging and risk management strategies. 3.2 Market volatility and liquidity. Higher levels of market volatility and liquidity challenges are common characteristics of emerging markets. Here are some factors that contribute to these challenges and how they can impact investors. Economic and political factors. Emerging markets are often characterized by higher levels of economic and political volatility compared to developed markets. Economic instability, policy changes, geopolitical tensions, and regulatory uncertainties can lead to increased market volatility. Investors need to closely monitor macroeconomic indicators, political developments, and policy changes to assess the potential impact on investment returns. Limited market depth. Emerging markets typically have smaller and less developed financial markets compared to developed markets. This can result in limited market depth, meaning there may be fewer participants and lower trading volumes. Limited market depth can lead to wider bid-ask spreads, increased price volatility, and potentially higher transaction costs for investors. Currency volatility. Emerging market currencies can be more volatile compared to major reserve currencies. Fluctuations in currency values can have a significant impact on investment returns, especially for foreign investors. Currency volatility introduces an additional layer of risk and uncertainty that investors need to consider when investing in emerging markets. Liquidity constraints. Emerging markets may have liquidity constraints due to various factors, including limited market participants, lower trading volumes, and less developed financial infrastructure. This can make it more challenging for investors to buy or sell securities at desired prices, particularly for larger transactions. Illiquidity can increase the risk of price slippage and limit investors' ability to exit positions quickly, which can affect investment strategies and portfolio management. Information asymmetry. Emerging markets often have less transparent and less readily available information compared to developed markets. This information asymmetry can make it more difficult for investors to make informed decisions. Investors need to conduct thorough research, engage local expertise, and stay updated on market developments to navigate the information gaps and manage risks effectively. Regulatory and legal environment. Emerging markets may have evolving regulatory frameworks and legal systems that can introduce uncertainties and challenges for investors. Changes in regulations, corporate governance standards, or legal procedures can impact investor rights, ownership structures, and the overall investment climate. Investors should carefully assess the regulatory and legal environment to understand the potential risks and ensure compliance with local laws and regulations. Country-specific risks. Each emerging market presents its own unique set of risks, including country-specific economic, political, social, and environmental factors. These risks can include inflation, currency convertibility, expropriation, sovereign debt default, social unrest, and natural disasters. Investors need to conduct thorough country risk assessments to understand and manage these specific risks, despite the challenges associated with higher volatility and liquidity constraints. Emerging markets also offer opportunities for potentially higher returns and diversification benefits. To navigate these challenges effectively, investors should have a well-defined investment strategy, conduct thorough due diligence, diversify their portfolios, manage risks through proper asset allocation and risk management techniques, and stay informed about market developments. Working with local experts and leveraging their insights can also help investors navigate the nuances of specific emerging markets. Navigating market fluctuations and ensuring liquidity in challenging market conditions requires careful planning and strategic considerations. Here are some strategies to help investors navigate market fluctuations and ensure liquidity. Diversification. Diversification is a key strategy to manage risk and enhance liquidity. By diversifying investments across different asset classes, sectors, regions, and currencies, investors can reduce their exposure to any single investment and spread their risk. Diversification can help mitigate the impact of market fluctuations and provide liquidity options by having investments in different markets or asset classes that may perform differently under varying market conditions. Asset allocation. Effective asset allocation involves allocating investments across different asset classes based on risk tolerance, investment goals, and market conditions. By diversifying investments among equities, bonds, cash, and other assets, investors can balance risk and return potential. Adjusting asset allocation based on market conditions and rebalancing regularly can help manage liquidity needs and adapt to changing market dynamics. Cash reserves. Maintaining an adequate cash reserve is essential to ensure liquidity during market fluctuations. Cash reserves provide a buffer to cover short-term liquidity needs and take advantage of investment opportunities that may arise during market downturns. Having cash on hand allows investors to meet their financial obligations without being forced to sell investments at unfavorable prices. Active monitoring and risk management. Regular monitoring of investments and market conditions is crucial during periods of market volatility. Stay informed about economic indicators, corporate news, geopolitical events, and policy changes that can impact the markets. Implement risk management techniques such as stop-loss orders, limit orders, and trailing stops to manage downside risk and protect against significant losses. Access to multiple liquidity sources. Ensure access to multiple liquidity sources to meet potential liquidity needs. This can include maintaining relationships with different financial institutions, having access to credit lines or emergency funding, and considering investment vehicles that offer easy liquidity, such as exchange-traded funds, ETFs, or mutual funds. Understanding the liquidity terms and conditions of investments and having a clear exit strategy is essential. Scenario planning. Anticipate various market scenarios and develop contingency plans. Identify potential risks and their potential impact on liquidity and investment portfolios. By scenario planning and stress testing investment strategies, investors can assess the resilience of their portfolios under different market conditions and make informed decisions to manage liquidity effectively. Active cash flow management. Monitor cash flows and manage expenses effectively to maintain sufficient liquidity. Regularly review income streams, expenses, and investment performance to ensure that cash flows align with liquidity needs. Consider strategies such as staggered investment or withdrawal plans to smoothen cash flows and minimize the impact of market fluctuations. Flexibility and long-term perspective. Maintain flexibility in investment decisions and avoid making hasty or emotional decisions during market fluctuations. Maintain a long-term perspective and consider the fundamental factors driving investments. A long-term perspective allows investors to ride out short-term market fluctuations and capture potential returns over time. It is important to note that these strategies should be tailored to individual investment objectives, risk tolerance, and financial circumstances. Consulting with a financial advisor or investment professional can provide personalized guidance and help develop strategies to navigate market fluctuations and ensure liquidity based on individual needs and goals. 3.3 Political and geopolitical risks. Investing in emerging markets comes with inherent political and geopolitical risks that investors should carefully assess. These risks can impact the stability and profitability of investments. Here are some key political and geopolitical risks associated with investing in emerging markets. Political stability. Emerging markets may experience political instability due to factors such as government transitions, civil unrest, social conflicts, corruption, and policy changes. Political instability can lead to economic disruptions, regulatory uncertainties, and a deterioration of the business environment. Investors should assess the political stability of a country before making investment decisions. Policy and regulatory risks. Emerging markets may have evolving regulatory frameworks and inconsistent enforcement of laws. Changes in regulations, tax policies, trade policies, or government interventions can impact business operations, profitability, and investment returns. Investors should closely monitor policy developments and assess the potential impact on their investments. Sovereign risk. Sovereign risk refers to the risk of a government defaulting on its debt obligations. Some emerging markets may have higher levels of sovereign risk due to factors such as high public debt, fiscal deficits, currency instability, and limited access to international capital markets. Investors should assess a country's creditworthiness and sovereign debt sustainability before investing. Currency risk. Emerging market currencies can be volatile, and currency fluctuations can impact investment returns. Political and geopolitical events, such as elections, government policies, or geopolitical tensions, can trigger significant currency movements. Investors should carefully assess currency risk and consider hedging strategies to manage currency fluctuations. Geopolitical tensions. Emerging markets may be susceptible to geopolitical tensions, including territorial disputes, trade conflicts, regional conflicts, or diplomatic tensions. Geopolitical events can lead to market disruptions, increased volatility, and heightened risks for investors. Monitoring geopolitical developments and assessing their potential impact on investments is crucial. Corruption and bribery. Some emerging markets may have higher levels of corruption and bribery, which can pose risks to investors. Corruption can lead to unfair business practices, lack of transparency, and compromised legal and regulatory systems. Investors should conduct due diligence on the governance and integrity of the markets they are considering investing in. Social and environmental risks. Emerging markets often face social and environmental challenges, such as income inequality, labor issues, human rights concerns, and environmental degradation. These risks can lead to protests, regulatory actions, reputational risks, and operational disruptions for companies operating in those markets. Investors should consider the social and environmental factors and assess their potential impact on investments. To assess and manage political and geopolitical risks in emerging markets, investors should conduct thorough country risk assessments, stay informed about political developments and geopolitical dynamics, and engage local expertise and research resources. Diversification across countries and regions can also help mitigate the impact of political and geopolitical risks. It is essential to carefully evaluate the risks and potential rewards associated with investing in emerging markets and align investment strategies with risk tolerance and long-term objectives. Consulting with experienced investment professionals and risk management experts can provide valuable insights and guidance in navigating these risks. Geopolitical events can have a significant impact on market stability, both in the short term and the long term. The nature and severity of the impact depend on various factors, including the specific event, the countries involved, the region's economic and political significance, and the market's overall sensitivity to geopolitical risks. Here are some potential impacts of geopolitical events on market stability. Market volatility. Geopolitical events often trigger increased market volatility as investors react to uncertainty and risk. Sudden political developments, such as conflicts, elections, policy changes, or trade disputes, can lead to sharp market movements, including increased stock market volatility, currency fluctuations, and changes in commodity prices. Higher volatility can make it challenging for investors to make informed decisions and can result in wider bid-ask spreads and increased trading costs. Investor sentiment and risk appetite. Geopolitical events can significantly influence investor sentiment and risk appetite. Negative geopolitical developments can lead to a flight to safety, with investors seeking less risky assets such as government bonds or stable currencies. Riskier assets may experience sell-offs as investors become more risk-averse. Conversely, positive geopolitical developments or resolutions of conflicts can improve investor sentiment and boost risk appetite. Leading to a positive market response. Business and economic disruptions. Geopolitical events can disrupt business operations and economic activities, impacting market stability. Trade conflicts, sanctions, political unrest, or terrorist attacks can disrupt supply chains, hinder business activities, and reduce investor confidence. These disruptions can result in lower corporate earnings, reduced investment flows, and overall economic slowdowns, affecting market stability, currency fluctuations, and capital flows. Geopolitical events often lead to currency fluctuations as investors reassess the risk and potential impact on a country's economy. Investors may move capital out of countries perceived as high risk or invest in safe haven currencies. Currency fluctuations can impact export competitiveness, foreign direct investment, and the overall stability of financial markets. Capital flows can be volatile, leading to potential liquidity challenges and market instability. Sectoral and regional impacts. Geopolitical events can have sector-specific or regional impacts depending on the nature of the event. For example, conflicts in oil-producing regions can disrupt oil supplies and impact energy markets globally. Trade disputes between major economies can affect specific industries reliant on international trade. Geopolitical events can also have spillover effects, impacting neighboring countries or regions with economic or political ties. Leading to broader market instability. Long-term investment outlook. Geopolitical events can influence the long-term investment outlook and reshape market dynamics. Significant geopolitical shifts, such as changes in trade policies, alliances, or geopolitical power structures, can have lasting impacts on market stability and investment opportunities. Investors need to assess the potential long-term implications of geopolitical events and consider adjusting their investment strategies accordingly. It is important to note that the impact of geopolitical events on market stability can be complex and multifaceted. Different events will have different degrees of influence, and their effects may vary across markets and asset classes. Careful analysis, monitoring, and understanding of geopolitical dynamics, coupled with a diversified investment approach and risk management strategies, can help investors navigate the potential impact of geopolitical events on market stability.